Put down the charts for a second, because if you're staring at silver right now and thinking, okay, it's back to $74, so everything is fine, you're about to get dragged by the exact trap this market sets for grown adults. Yesterday wasn't a normal sell-off. Yesterday was a historic $10 crash from $84 down to 72s, the kind of move that doesn't just wipe out positions, it rewrites behavior. And then this morning, silver does what it always does when the crowd is emotionally injured. It violently rebounds and reclaims $74 like nothing happened. So now the internet is split into two religions. One side is screaming, dead cat bounce, bubble popped, it's over. The other side is screaming, dip of the decade, bear trap, shorts are cooked. And most people watching this are about to do the one thing that ruins them. They're going to pick a team and then bet their emotions. We're not doing that. Because the only way to survive a market like silver, especially after a shock like yesterday, is to stop asking, is it bullish? And start asking, who is forced? Because forced behavior is the engine, not vibes, not opinions, not memes. So in this video, I'm going to do three things. I'm going to explain what yesterday's crash really was, not the story people tell, but the mechanics underneath it. I'm going to explain what today's rebound to $74 could mean, bear trap or super bubble pop, and why both can look identical for a few hours. And I'm going to give you a clean framework, the signals that tell you in real time which world you're in, because this is the moment where the market selects who gets to stay on the ride and who gets shaken off. All right. What yesterday really did to this market. Yesterday's move from $84 to $72 didn't just drop the price, it did four brutal things at the same time. One, it liquidated late longs. People who chased the breakout, people who bought the top, people who used leverage because they thought this time is different. The market didn't punish them politely, it erased them. Two, it created false confidence for shorts. When a market drops $10 in one day, shorts feel like geniuses. They start thinking this is the start of a bigger collapse. They start adding, they start pressing. And when shorts press, that's how traps form. Three, it rewired risk desks. This part matters more than anything. After a move like that, brokers tighten rules. Margin gets raised, leverage gets reduced, position limits shrink. The game changes without the chart telling you. Four, it turned silver into an emotional event. Now every candle feels personal. Now every tick triggers fear or greed, and that's exactly what this market wants, because emotional people become forced people, and forced people are easy to farm. So before you even interpret the rebound, you need to respect what happened yesterday. Yesterday didn't end a story. Yesterday reset the battlefield. Why $74 is a psychological weapon. Now let's talk about today. Silver rebounds. Reclaim $74. And I know what your brain wants to do. Your brain wants to go, okay, it's back above $74, so it's safe again. Or, okay, it couldn't hold below 70 tau, so the dip is the dip. Listen, levels like $74 after a crash are not support. They are psychological bait. They are the market offering comfort to the maximum number of people. And comfort is not a gift. Comfort is how markets trap you. Because right now there are three groups staring at the same number. Group A, the hurt longs. They're thinking, please, let me get out near break even. So they sell into the rebound. Group B, the proud shorts. They're thinking, it's just a bounce. I'll short $74 and write it down again. So they short the rebound. Group C, the late dip buyers. They're thinking, okay, it's going back up. I'll chase again. So they buy the rebound. That means $74 becomes a crowded zone, and crowded zones are where the market does the most damage. So again, our job is not to worship $74. Our job is to ask, is this rebound driven by real demand or forced behavior or just temporary relief? Because each one leads to a different future. After a historic crash, a rebound like this usually comes from one of these three engines. Engine 1, dead cat bounce. Relief rally. This is the simple version. Selling exhausted. Bargain hunters step in. Short-term traders buy the dip. Price lifts. Then it fades. Dead cat bounces feel reasonable. They feel tradable. They give you time. Engine 2. Bear trap. Shorts get snapped. This is the dangerous one for shorts. After the crash, shorts pile in. Then price rebounds fast, stops trigger, margin pressure hits. Shorts are forced to buy back. That buying pushes price higher. More shorts get forced. Bear traps feel rude. They move before you're ready. They don't give you a clean entry. Engine 3, super bubble pop, trend breaks. This is the grim version. The crash wasn't a shakeout, it was a regime change. Big money uses the rebound to sell. Liquidity is gone. The market starts making lower highs. Rebounds get weaker. The bubble slowly leaks. This one is sneaky because it doesn't always look like a collapse right away. It looks like chop. It looks like still bullish. Until one day, it doesn't bounce. So those are the three worlds. Now, how do we tell which world we're in? We don't guess. We don't pray. We watch behavior. Yesterday's $84 to $72 crash. How it happens in real life. Let me explain yesterday in plain words. Moves like that are usually not caused by one thing. They're caused by a chain reaction. It often goes like this. Step 1. $84 becomes a magnet. When silver pushes to a big round area near the highs, people pile into the same idea. Late longs chase. Options bets stack. Stops tighten. Leverage grows. So the market becomes fragile. Step 2. A shove hits thin liquidity. It can be profit-taking. It can be a large seller. It can be a wave of forced selling. It can be a mix. But the point is, the market doesn't have enough buyers at that moment, so price drops. Step 3. Stops become gasoline. Stops are not opinions. Stops are orders. So when stops trigger, selling accelerates. Step 4. Margin turns a drop into a waterfall. As volatility jumps, margin can tighten. Now some traders aren't choosing to sell, they're being forced. Step 5. The crash becomes a story after it already happened. And this is where people get tricked. They look for a headline, they blame a narrative, they invent a reason. But the real reason is usually mechanical. Too many people were positioned the same way at the same time, in a thin market, with leverage attached. That's silver. That's why it's glorious when you're right. And brutal when you're emotional. Why today's rebound can be bullish and bearish at the same time. Here's the part that confuses people. A rebound after a crash can be bullish and bearish at the same time, depending on your time frame and depending on who is doing the buying. Because two very different things can push price back to $74. Buying because someone wants silver, that's demand. Buying because someone must cover risk, that's forced. Forced buying can lift price hard and still fail later. Demand buying can lift price slower and hold. So the chart alone won't tell you. We need the signals, we need the footprint, we need to see if this rebound is fragile, relief, or urgent, trap, or strategic, distribution. So let me give you the checklist. Signal 1. Does the rebound feel easy or violent? Dead cat bounces often feel smooth. Bear traps feel violent. If price snaps upward, rejects dips instantly, and moves like the market is in a hurry, that's not normal buying. That's forced behavior. Signal 2. Do dips get bought fast or do they drift? In a real bear trap, dips don't drift. They get slapped because shorts are trying to escape and buyers are stepping in early. In a dead cat bounce, dips drift lower because nobody is desperate. Signal 3. Does the market reclaim levels that shouldn't be reclaimed this fast? After a $10 crash, most people expect a slow recovery. So if silver reclaims key levels quickly, that tells you something changed, not feelings. Positioning. Signal 4. Do rebounds get sold immediately or do they hold? In a bubble pop scenario, rebounds are selling opportunities. So you'll see. Pop, sell, lower high, pop, sell. It's like a sick heart monitor. It keeps trying to recover and keeps failing. Signal 5. Does volatility stay hot as price rises? This is huge. In healthy recoveries, volatility calms down. In forced unwind moments, volatility stays hot because the market is still unstable. Hot volatility with a rebound often means the market is not calm. It's fighting. Signal 6. Does the market refuse to give you a comfortable entry? Squeeze-type moves don't feel fair. They don't give you the perfect dip. They leave people behind. Dead cat bounces feel fair. They give you time to decide. So ask yourself, does this move feel like a gift or a rush? The bear trap story, how shorts get caught right here. Now let's talk about the bear trap scenario, because after yesterday, shorts are tempted. They saw $84 to $72. They smell blood. They believe the bubble popped, so they short. But here's their problem. After a crash like that, risk desks tighten. So the amount of pain shorts can take becomes smaller. And if silver rebounds just a few dollars, shorts can hit. Stop losses, margin pressure, forced reductions cover orders. This is why bear traps often happen right after a crash. The crash convinces shorts the coast is clear. Then the rebound snaps their neck. So what does a real bear trap look like from here? It usually looks like this. Reclaim $74 quickly, hold above it longer than bears expect, push into the next level and force more cover, create a second leg that looks impossible. Everyone calls it manipulation. Shorts get liquidated anyway. Bear traps don't need a big catalyst. They only need crowded shorts in a thin market. The dead cat bounce story. Why it's still possible now. Do not let excitement blind you. Dead cat bounce is still on the table because dead cat bounces are common after big crashes. Selling pauses. People buy the dip. Price rebounds. Then reality returns. If this is a dead cat bounce, here's what you'll see. The rebound struggles above $74. It can't reclaim higher zones. It starts making lower highs. Dips start lasting longer. Volume dries up. The market feels tired. Dead cat bounces don't have urgency. They have relief. They feel like, okay, the panic is over. And then they roll. So the key difference is not the bounce. The key difference is what happens after the bounce. Does the market keep pressing higher? Or does it keep failing? The super bubble pop story. What that really means now. Let's address the scary phrase, super bubble popped. People throw that around because it sounds dramatic. But what does it mean in real market behavior? It means the market may have shifted from momentum-driven buying to distribution and risk reduction. In plain words, the big money starts using bounces to sell, and the market stops rewarding dip buyers the way it used to. This doesn't always happen in one day. Sometimes it happens in a slow bleed. But yesterday's $10 crash is the kind of event that can start it. So what would confirm a pop? Not one bounce to $74. Confirmation looks like repeated failure to reclaim important levels, lower highs forming, quickly bounces, getting weaker support, breaking again after a few attempts, and the market turning into a sell the pop rhythm. That is how bubbles die, not with one candle, with a change in rhythm. The two worlds again, screen price versus real tightness. Now we have to bring in the concept that saves your sanity. There are two worlds. Screen world. You see 84, you see 72s, you see 74s, you panic. Real world. People care about real availability, real delivery time, real premiums, real bids for size, real stress and positioning. Here's why this matters. A market can crash on the screen while real tightness stays, and a market can rebound on the screen while real demand is still cautious. So if you want to know whether this is dip of the decade, you don't just stare at $74. You ask, is the real world tightening or loosening? And you can feel that in things like how quickly dips get bought, whether price reclaims levels and holds, whether panic returns on the sell side, and whether the market looks like it's trying to escape upward. I'm not asking you to be a scientist. I'm asking you to watch behavior instead of headlines. Why dip of the decade is a dangerous phrase. Now listen, I understand why people want to call this dip of the decade, because it feels heroic. It feels like you're buying fear. But here's the truth. The phrase dip of the decade is how people get tricked into oversizing, and oversizing is how silver eats you alive. Because silver is not a market that rewards pride. Silver rewards preparation. So yes, this might become a legendary dip, but you never treat a violent market like a sure thing. You treat it like a storm. You reduce the ways you can die. That's the difference between a survivor and a screenshot trader. What I'm watching next, the real roadmap. Okay, here's the practical roadmap, not predictions, signals. 1. Does $74 hold on the next pullback? If $74 holds and dips get bought quickly, that supports bear trap, squeeze behavior. If $74 fails easily and price slides back, that supports dead cat bounce, just pop behavior. 2. Does silver reclaim $75, $76 with ease, or does it struggle? After a crash, struggling is normal. Ease is information. If it glides through, someone is urgent. 3. Do we see a second push after the first rebound? The first rebound can be relief. The second push is where it becomes serious. If the market makes a second push and holds, shorts start to feel danger. 4. Do we get no perfect entry price action? If you keep waiting for the perfect dip and it never comes, that's what squeezes feel like. 5. What happens overnight? Overnight moves often reveal who is forced, because thin liquidity amplifies urgency. If silver keeps doing rude moves outside normal comfort hours, that's not casual trading. That's positioning. The psychology trap: why both sides will get wrecked. Let me annoy both camps. If you're a bull, don't let the rebound make you reckless. You just watched a $10 crash. That means the market can destroy your confidence whenever it wants. If you're a bear, don't let yesterday's crash make you arrogant. Violent markets love to punish the side that gets proud. A bear trap after a crash is one of the oldest tricks in the book. If you're new, do not confuse volatility with clarity. Volatility is not a signal that you must act. Volatility is a signal to manage risk and slow down. This is not financial advice. This is how not to get emotionally farmed advice. If you trade paper, use less size than your ego wants. Expect fake outs. Respect that you can be right and still get forced out. Avoid being married to one narrative. If you hold physical, remember your world is not the candle. Your world is whether this market is tightening long term, whether availability is changing, whether the system is shifting into a new regime. A screen crash doesn't delete physical reality, but it can create the moments where strong hands accumulate and weak hands exit. And silver has always been a transfer market. It transfers the asset from the impatient to the patient. This rebound to $74 is not proof of anything yet. It's the first test. It's the market asking, did yesterday break the trend, or did yesterday create the fuel for the next leg? If $74 holds and we see urgency, fast dip buying, rude pushes, no comfortable entries, then yes, this could be a bear trap setup. Shorts could be trapped, and the dip of the decade narrative could build. If $74 fails and bounces get weaker, lower highs, slow selling, no urgency, then we take the other path. The bubble may have started leaking, and yesterday may have been the first crack in a bigger shift. Either way, the move is not the story. The behavior is. So here's what I want you to do. In the comments, tell me what you're seeing on your chart right now. Is the rebound holding and refusing to give back ground? Or is it already fading and looking tired? And if you want part 2, where I map the next pressure zones and explain exactly what a real bear trap looks like before it becomes obvious, comment one word, trap, because in silver, the moment you think the game is over is usually the moment the game begins. I'll see you in the next one.